Welcome everyone to BDO's webinar focused on professional service firms. My name is Anna Jarrold and I am the tax partner leading our professional services tax team in the UK, which is 25 people strong. For those of you who do not already know, BDO is a global accounting network with over $7 billion in revenues, providing auditing, accounting and taxation services in 152 countries with over 64,000 people. Today's webinar is to update you on VAT matters affecting professional service firms, and our specialist speaker is Micheal Ashdown. Micheal is a tax director with 30 years of experience from our VAT team and with whom I and others in my team work very closely with. You can ask questions during the webinar. Please use the Q&A feature, which is in the top right-hand corner of your screen, and please send questions to all of our panelists. We will address as many of those questions as we can at the end of the webinar, or if time does not permit, after the webinar. We're also recording the webinar and we will email you the slide deck as well as the recording. We will finish within the hour. Over to you, Micheal.
Thank you very much, Anna. Today we are going to try and cover a variety of VAT topics. We are going to look at some technical updates that have come out from HMRC and from the European Commission, but we are also going to be talking about a number of practical issues. We will be talking about Brexit, as that has been a lot in the news recently. We're going to be looking at VAT rules around place of supply. That is important about when we charge VAT and if we have to register elsewhere. Disbursements is always a topic which is interesting. Do we have to add VAT onto our disbursements or not? Deal fees has been an ongoing topic over a number of years following the BAA case. We are now able to provide some further guidance on this as HMRC has issued some draft guidance on the topic. Then want to pick up on some sort of practical issues. These have come from our experience of dealing with HMRC in their dealings with professional firms. It's probably fair to say that HMRC has been quite quiet in the past in its dealings with professional practices and other firms and other clients. I think there is now a lot more interest from HMRC in all businesses. HMRC is now a lot more coordinated in its approach on VAT inspections and on meeting taxpayers. So hopefully we will have quite a good mix of different topics. First topic I want to talk about is Brexit. Brexit has now been a lot in the news. We had the referendum last year with the vote to leave, and we have heard the vote in Parliament going through about the triggering of Article 50. Obviously, VAT is a European tax. The basis of VAT comes from a number of EU directives, and having a VAT system is a requirement of EU membership. It was for this reason that the UK introduced VAT back in 1973 when we joined what was then the European Economic Community. It's probably fair to say that VAT is the most European-based of all the tax regimes in the UK, and that has been confirmed by documents which have been lodged in the House of Commons library this morning. We are therefore expecting there will be some changes, but we have to wait and see what happens. Any business that deals in goods is probably likely to have many more changes as a result of Brexit. People moving goods around will be back into the regime of imports and exports, and with a need to complete customs declarations for goods moving around the EU. For services, we expect it to have less of an effect because the old UK VAT regime usually relieved supplies of services to businesses elsewhere from VAT prior to the recent EU changes. So we're likely to have less changes for services as a result of Brexit, but we can make no assumptions as to what is likely to happen. What is possibly likely to happen is that there will be greater flexibility over our rates that we set for VAT. At the moment, we can only have a reduced rate of 5%, and we cannot go any lower than that. We also cannot extend our zero rates. It's possible that after we have left the EU, we will have a greater flexibility to vary rates and deal with other changes that we may wish to introduce in the UK for social reasons. One change that is likely to affect suppliers of services is that once we have left the EU, in 2 years' time, there will no longer be a requirement to complete EC sales lists for services, or for people supplying goods no longer to make intrastat declarations. Probably worth pointing out, though, that we are not going to be leaving the EU for at least another 2 years, and until that happens, businesses will still have to comply with all of the current obligations. So we will still have the requirement for businesses to complete quarterly EC sales lists for their supplies of services to other EU member countries.
Michael, just on that, people value certainty. Do you think we're going to hear much about the negotiations in the 2-year period while we're waiting to actually exit?
I think it's an interesting question as to whether we will hear anything about the negotiations. Our understanding is that the Treasury have said that they will not be updating people as to how the negotiations are going because they do not wish to spoil their negotiating hand. So I think it's probably unlikely that we will hear anything until everything has been finally decided, unfortunately. Right. Case of wait and see, and I think the Treasury has already told people do not make any assumptions about what it will be like.
Yeah, as expected on lots of other matters.
As expected on lots of other matters.
Okay.
We'll now sort of turn to look at the question of the place of supply of services for VAT purposes. This is a topic which raises lots of issues and causes many complications for businesses. It's probably the topic we probably get most of our questions from professional firms about. Do we have to charge VAT in these situations or do we not? It raises a number of questions. It raises the question about where VAT is actually charged on a service. It also raises questions about who actually then accounts for the VAT. And that may lead you to have potentially an obligation to register for VAT in another EU country if you are making supplies which have a place of supply in that country. So just to go over the current rules for place of supply, they are different depending on whether you are dealing with a business or whether you are dealing with an individual. The general rule is that for supplies to individuals, B2C supplies, the VAT place of supply is where the supplier is based, and you therefore charge VAT in accordance with the normal rules in your own place of establishment. It is different, though, for VAT on business-to-business transactions. VAT is supposed to be a tax on consumption, and the VAT is supposed to be counted for where the customer is based if they are in business. So for business-to-business transactions, the place of supply is where the customer is based. This means that if you are supplying services to a business customer elsewhere in the EU, these services are deemed to be outside the scope of UK VAT. You do not charge VAT, and generally it will be the business customer that will account for this VAT. Obviously, it's not possible just to treat without any evidence that these supplies are supplied to a business, and all businesses are required to keep evidence to support the fact that their customer is in business. The best proof, as we know, is the VAT number of your EU business customer. If that is available, if the customer is VAT registered, you are required to obtain that number and then quote it on your invoice. You will also need it when you complete the quarterly EC sales list, which you submit to HMRC which lists the supplies of services made to business customers which have not been liable to UK VAT. If, however, the customer is not VAT registered for whatever reason, but they are in business, it is possible to obtain other evidence of their business status. That would depend upon the exact situation. So those would be the general rules. Obviously, there are different rules which apply to services involving admission or short-term hire of means of transport. But the general rule applies to all other services with the exception of land-related services, which we will talk about in a minute. So the general rule is VAT is due where the business customer is established. It doesn't really matter where the work is physically carried out. All of the work can be physically carried out in the UK, but if your business customer is established elsewhere in the EU, the services are outside the scope of UK VAT, and the business customer will account for the VAT themselves on their VAT return. The one big exception, though, to the place of supply rules, and the one which has caused problems in the past, is the definition of land-related services. Any services relating to land, the place of supply for VAT purposes, where they are taxed for VAT purposes, is where the land is located. We've always had this rule in the UK. It's obviously part of the EU rules on VAT. And it doesn't matter, therefore, where the supplier is based or where the customer is based. It is purely determined by where the land is located. So you may be doing some work for an overseas customer, but if the land is based in, for example, the UK, you would still have to charge UK VAT. It also leads to a complication that if the land is in a different member state, you may therefore have an obligation to VAT register in that member state, especially if your customer is not established as a business in that country. So, for example, if you were working for an Australian customer and they were involved in negotiations for a piece of land in France, and you are involved in drawing up the contracts for the transfer of that land or advising on the valuation of that land, because the land is based in France, it would be liable to French VAT, and you may have a liability to register for that in that country. Interestingly, having talked about Brexit, we have some guidance which has come out from the European Commission in the form of implementing regulations. These are helpful because they have clarified what is regarded as a land service for these purposes. These regulations were introduced in 2013, and because they are EU regulations as opposed to a directive or anything similar, they have automatic effect in the UK without being enacted. And they came fully into force in January this year, and they have provided us with some further guidance on what land-related services are. And we're going to just look at those at the moment. As I said, this definition of what is land-related services has come from Council implementing regulations, and it's helpful because it has provided clarity as to what is and is what is not a land-related service. And as we said, that has issues about charging of VAT and possible registration for VAT elsewhere. Obviously, you need to have a land-related service. It has to either change the physical appearance of services of the land, so sort of construction services or installation services, but it also covers legal services if these result in the change of the legal ownership or of certain beneficial and other interests that are related to the land. Anything else, though, is probably not going to be seen as land-related services. We also see that things like installation services are now accepted as being a land-related service if the goods concerned become permanently fixed to the property. So this first slide lists what is seen as being land-related services. A number of them are ones which we always would have considered as being land services. drawing up of plans, as I said, construction services, property management of a UK property, so would be a land-related service. And it's important to point out there that that is specific property management services. It doesn't cover general asset management services, because that would be a general business-to-business services. One which has been added or has provided further clarity is services of site security, because these are now definitely seen as being land-related services. We did not have anything about that previously. Services of agents, for example, in making deals are seen as being a land-related service. So an estate agent negotiating a sale of a property, that is a service directly related to the land and to that property, and so the place of supply will be where that land is located, irrespective of where the agent is or where the customer who is buying the property. We do possibly need to be careful and also to consider what happens if instead of selling a property, you are actually involved in selling a company that owns the property. That has a slightly different VAT treatment, and that would be seen as a sale of a company and is likely to be exempt from VAT, so that would have a different VAT treatment, but purely the sale of a property itself is definitely a land-related service. If we possibly think now of services which are not land-related, and this is where the implementing regulation has been a lot more helpful. There were often disputes as to what was a land-related service and what was not. The regulations now say that if a firm is simply advising on the terms of a property contract, or possibly providing advice about enforcing a contract, that is not seen as being land-related. If that is all you are doing, just providing advice to a client on the terms of a property contract, that is not a land-related service. However, if you are advising on the terms of a property contract, and that is part of the deal then to arrange the transfer of title in the property, that will be seen as land-related, and we're back into the previous rules. But simply advice on the terms of a contract or the way that a contract is to be enforced, that is no longer seen as being land-related. So I think the implementing regulations, I know they are a piece of EU regulations which have just come into force, they are very helpful and will help a lot in some of these disputes that may happen.
Michael, can I just ask you, what happens where we're providing tax work for a property owning company? Is that land-related?
It's quite interesting because the work obviously has a major link to the property, particularly if we're doing things along the lines of maybe tax returns for a property owning or a non-resident landlord. That, though, has always been accepted as a result of a case to be seen as being not a land-related service. There is a case called W.H. Payne from about 1997 where a Jersey property owning company had UK tax returns done because it owned a UK property, and the courts actually found that was not a land-related service, and as a result VAT does not need to be charged if the only establishment is the property that they have in the UK.
Right.
And HMRC have now accepted that, and that is now will be incorporated into their guidance.
Thank you.
As I said, there is quite a lot of areas around this, and hopefully this now gives us some clarity. Just want to quickly mention sort of the treatment of disbursements from a VAT point of view. Disbursements being those items which are charged by a firm in addition to their services. It could be travelling costs, it could be costs that they have paid on behalf of the client to a third party, or it could be legal costs that they have incurred from tax counsel or other counsel. I think one issue is that for VAT purposes, there is a different definition of what is a disbursement from what may be the definition for legal purposes. It's only possible not to charge VAT on a disbursement if it meets all of the conditions to be a disbursement for VAT purposes. HMRC has listed their 8 conditions which they think need to be met for a supply to be treated as a disbursement and for allowing it to be charged free of VAT. These conditions include that the client knows that it is a third party who is being provided this service. For example, that the client specifically authorises the payment to be made, that only the exact amount is actually being paid over as the third party is charging, and that the service is not being used to be part of a service that the firm is providing onwards to its clients. So there are not many things which would actually sort of come within the definition of being a disbursement for VAT purposes. Possibly payment of the SDLT on a property purchase is one which is an example of something which is a disbursement for VAT purposes, and therefore VAT is not charged on top of that, even if you are billing it to a UK client. Issues around things like sort of property searches, though, are more difficult to confirm, because if it becomes part of the supply that the firm is making, HMRC says that is not a disbursement. So if you obtain a local authority search, for example, and then use that as part of your work for the client, you, for example, go through it, sort of comment on it for the client, make recommendations based upon that, HMRC says that is not a disbursement and it is charged as part of the supply, and it will take the same liability as the supply. So if you're charging VAT on the supply, you would charge VAT on a disbursement. If, for example, though, you purely got a search and just passed it straight on to the client without doing any work on it, didn't comment on it, HMRC would probably accept that is a disbursement for VAT purposes. Council fees is quite an interesting topic because, generally speaking, although they might be called disbursements on bills, they are generally seen as part of the cost of making the supply to the end client. So the normal treatment would be that council would bill the professional firm plus VAT, the firm recovers the VAT, adds council's fees on, possibly showing it as a disbursement, and then charges VAT as appropriate on the total bill. Obviously, if you're then billing an overseas client, you would not charge VAT on any part of that. There is a concessionary treatment that council has available if it is involving certain conditions, and these were agreed by the Law Society and HMRC, and it does say in certain conditions are met, council can treat its fees as being charged directly to the overseas client and not have to charge VAT on those, even if they are passed through a UK firm. One thing which is not, though, a disbursement is travel costs. Many firms will separately bill on travel costs to a client, and they are not seen usually as being a disbursement for VAT purposes. There is a case all the way back to 1975, almost the beginning of VAT, called Rowe and Moore, involving a professional firm, and the Court of Appeal decided that the costs of the travel were part of the costs of the firm in making their supply of services, and so therefore could not be treated as a disbursement and were therefore not outside the scope of VAT. So travel, even though there may be no VAT incurred on it when it is incurred, for example, because it's rail travel which is zero-rated, or it's a flight one, which again there is no VAT, if it is charged onto the client as part of your fee, it is not a disbursement for VAT purposes, and VAT should be charged in the normal way.
Michael, you mentioned that it's generally not treated like a disbursement. Is there a case where it can be?
It's interesting, a question about when you could have a travel disbursement is a true disbursement for VAT purposes. I think probably the only time that you would ever be able to have that treatment was if the firm was buying a ticket for the actual client itself, and it was the client themselves who were travelling. So if, say, a firm was going to a meeting and the client was coming with them, and it was easier for the firm to book all of the tickets, because the client actually benefits from the travel in that case, the client's one could, in that case, be treated as a disbursement. But travelling costs for the professional firm itself would not meet the disbursement costs. And it's something which HMRC will look at on bills, because anything where VAT is not charged gets HMRC sort of interested.
Okay.
I'd now like to talk about something quite topical, which is the question of deal fees, and especially the VAT recovery around VAT on the deal fees. This stems from the case of BAA, British Airports Authority. It was a case where the Spanish company Ferriola was taking over BAA, and it formed a bid company called ADIL to actually take over BAA. The discussion happened, the company then entered into negotiations and bought BAA. A number of months later, the company ADIL, which was the bid company of Ferriola, applied to join the BAA VAT group, and that was accepted. And then it looked to recover VAT on all of the professional fees that had been incurred by ADIL from a number of the different professional advisors. As we can imagine, as it was such a big case, there were large amounts of VAT involved. HMRC, though, disallowed the VAT on this case, and it went before the courts. And as a result, there has been a great deal of discussion about how deal fees should be treated for VAT purposes, what needs to be done by a company to ensure VAT recovery. HMRC has been quite strict on companies, and they have been saying, with your bid company, which has been trying to recover VAT, how are you entitled to recover this VAT? You are a bid company, you were only formed 2 days ago, for example, and these costs were incurred over 6 months ago. How were you therefore able to incur these costs? There's not a lot that can probably be said about that. So hopefully the new guidance, we have some clarity about how we deal with that. Also, there have been cases heard before the Court of Justice of the European Union in a case called Laurentia and Minerva. It was one case, and it was looking at the treatment of deal fees and also about VAT grouping. And partly as a result of this, you will have seen that HMRC has launched a consultation on VAT grouping, which is currently open, looking at what companies or what entities are able to join a VAT group. But it was mainly to do with the treatment of deal fees. We have been expecting some comments from HMRC as a result of this case, and there was like expectation that they would issue a new revenue and customs brief setting out their position. That, it seems, is now not going to happen. What has happened, though, in the interim is there have obviously been a great deal of discussions with HMRC on deal fees, and BDO has been involved in these discussions. One of our VAT partners has been involved in these ongoing discussions with HMRC about the treatment, and we now have some draft guidance which has been released, which hopefully will clarify the position and at least give some clarity. It doesn't necessarily answer all of our questions, but we have been able to have some clarity, and we have got away from some of the arguments that HMRC was advancing. HMRC was always saying that deal costs had to be recovered over a set period of time in order to be recoverable for VAT purposes. And in this new guidance, they have now moved away from that. This next slide sets out what the HMRC guidance is sort of saying at the moment. At the moment, it is still only draft guidance, and there may be some changes, but this is hopefully what is going to be the final product and how it is actually going to work in practice. The first point to make is the point about bidcos and how could they actually have received the supply if they are formed, as usually happens, the day before the deal happens. It says that for that to be recoverable, the party must contract for the supply, but HMRC have accepted that that could be by a novation of an existing contract. So most contracts with professional firms in these sorts of situations will have a clause which allows the contract to be novated to a BidCo at a later date. So HMRC say that the BidCo must contract for the supply, but thankfully they now accept that that can be by novation of an existing contract. BidCo must make use of the supply, it must pay for the supply, and importantly, it must hold an invoice made out in its own name. These are all fairly standard points for evidence to show that a business has received a supply of services, but thankfully HMRC do now accept, as I said at this point, that it can be done by novation of a previous contract where the company hadn't existed at the time the letter of engagement was signed. BidCo, though, must make or intend to make some sort of supplies of management services to its subsidiaries, and these management services must be the services to which the costs can be attributed. And we would like to see these actually documented, so we would recommend that there is always a formal agreement for these supplies of management services to its subsidiaries. That will then be a way of demonstrating that the bid costs in question are attributable to those onward costs. The guidance is saying that this should happen even if the company is going to be VAT grouped with its subsidiaries. We know that a VAT group is treated for VAT purposes as a single taxable person, and therefore there should be no VAT on these recharges. But HMRC still seems to want to see an agreement for a supply of management or other services to these subsidiaries. As well as there being this agreement in place, they want to see that there is going to be actual consideration paid for these services, and the guidance talks about that this consideration is genuine and more than just nominal. So by that they mean that we have a genuine value, and that they say that it's more than just £1 or something. So we want a genuine fee shown and that this is actually paid. And the reason for this is to show that the supply of services was actually made by the BidCo to the subsidiary companies. The problem has been that there has been case law, particularly involving sort of mining companies, where they said that yes, there would be management charges made, but the contracts had been very vague in those cases. It all depended whether the subsidiaries was going to be profitable, and there may not actually have been any management charges made. And in those cases, the tribunal said that there were not genuine management charges made, and that restricted VAT recovery. So what we are saying is, and what guidance confirms, is that management charges where payment is contingent causes a problem and will not lead to VAT recovery. So as well as having management fees for consideration, we do not want there to have those fees to be contingent on any future profitability. Also need to look at a situation if you have a holding company which then acquires a number of different companies, some of which it may actively manage and make management charges to, others where it just holds in a passive function. In the past, it was generally accepted that VAT recovery was allowable on all of the costs incurred. This new guidance is saying that VAT recovery will be restricted in these cases, and VAT recovery will only be possible in respect of those where there is the active management charge made, not where it is just held passively and no management charges are made. So if you have a number of subsidiaries, some of which are charged management fees and some of which are not, there will be a restriction in the VAT recovery on the deal costs.
Michael, just on that, does it make a difference where the subsidiaries are actually grouped with the holding company?
It shouldn't make a difference because we say that a VAT group is a single taxable person, but the guidance is saying that you do want genuine management charges to be made to subsidiaries even if they are in a VAT group. So basically we are saying they should be treated in the same way as if they were complete third parties in a different VAT group. So we want to see management charges, an agreement for the services, and for these services to be paid. The only difference would be if they're in a VAT group, there would be no VAT charged on those because those services are disregarded for VAT purposes. So I think where we got to is now quite a good outcome. We've been able to get away from HMRC saying the deal costs must be a cost component, and we now have perhaps more of a clarity as to how these are to be dealt with in future. Okay, we want to now talk about some more practical sort of topics that have come up in professional firms and what we are seeing in HMRC's dealings with professional firms. First one I want to talk about is salary sacrifice. It's also called salary exchange. You will have seen in the budget there was an announcement about some changes affecting salary sacrifice and looking to possibly try and restrict those changes. The issue around salary sacrifices, it is done mainly for employment tax reasons, and there are a number of benefits for employment taxes. But they often miss that there is a VAT issue, and these could lead to some big assessments. The big issue is that the VAT treatment has changed with effect from 2012. The established UK position on salary sacrifice for VAT purposes was that there was no supply being made if an employee sacrificed an element of their salary in return for benefits. This was based on case law, where the courts decided in the UK that if an employee had a choice of contract A, which gave them one salary, or contract B, which gave them a lower salary but gave them some additional benefits, that was a choice made by the employee, and there was no actual supply being made for VAT purposes. It was just a simple choice of which contract the employee wanted. As I said, there has been a case in 2012. AstraZeneca took a case involving salary sacrifice, which went to the European Court. And the European Court decided that because there is a direct link between the amount of salary which an employee sacrifices and then the level of benefits that they receive, that the amount of salary sacrifice is payment for those benefits. It's because there is simply this direct link, which we often look for in VAT purposes, between the amount of salary sacrificed by an employee and the benefits that they are provided. The effect of this is that if you are providing benefits which are liable to VAT to an employee by means of salary sacrifice, VAT now needs to be accounted for on those benefits which are liable to VAT. Examples of benefits which are liable to VAT and which have possibly been quite popular in the past is cycle to work or supply of retail vouchers. In both of those cases, those are transactions where they are VATable transactions for VAT purposes. They are liable to VAT at the standard rate, and therefore if an employee gets these benefits by means of sacrificing some of their salary, the business has to account for VAT on the amount of salary sacrificed. The amount of salary sacrificed would be deemed to be inclusive of VAT, and then VAT is accounted for in each and every one of those payments. Similarly, with a cycle to work scheme, if you then sell the bike to the employee at the end, that is a supply of goods made in the UK and is liable to VAT. There is obviously no VAT on benefits which are exempt, because all the European Court has said is that it is payment for a supply. If the supply, for example, is exempt from VAT, such as childcare vouchers or contributions to a pension scheme, there is no VAT to be accounted for on those, because those are exempt transactions. The issue is there may not be large amounts of VAT involved, but it is something which will allow HMRC to look at the business and to say you have not dealt with this correctly, and possibly then look at other activities that the business is undertaking. As I said, all it means now is that VAT needs to be accounted for on taxable benefits provided, such as cycle to work. Having said that, there are still a number of employment taxes benefits available, and the judgments have confirmed that the VAT on the costs associated with these taxable benefits are recoverable by the business. In the last part, I'm just going to pick up on some issues that HMRC commonly pick up on visits. We're going to talk about aged creditors, and you may think, what is the VAT issue there? But that is something which we will come on to. We're going to talk about VAT and business entertainment. I think it's possibly fair to say HMRC have a big obsession with entertainment and VAT recovery. Just talk about how you should be dealing with sort of supplies where VAT has not been charged in your dealings with HMRC, and then talk a little bit about penalties. The first issue is aged creditors, and this is a major issue at the moment. It is an area where we are seeing a large number of assessments which are being issued, and where HMRC is actually issuing and raising penalties on a business. There is a provision which is in the VAT legislation which says that if you have a purchase invoice, you're entitled to recover the VAT up front, whether you have paid it or not. The legislation says that if that invoice remains unpaid 6 months from the payment date, you are required to automatically unclaim the VAT. You have to pay back the VAT on any invoices which are unpaid after 6 months. So this is sort of similar to the bad debt relief which is available on your sales, but it is a separate provision and it's not linked. This is a compulsory adjustment on your creditors. It's not possible to say to HMRC, we are not going to adjust for this VAT because we haven't claimed bad debt relief on our sales. They are two separate things. Just because you haven't claimed bad debt relief on sales does not mean you do not have to adjust on your purchases. There is an automatic requirement to adjust for purchases if the invoice is unpaid after 6 months. Obviously, if you then pay the invoice later, you are again entitled to recover the VAT. There is potentially this period when you are not entitled to recover the VAT. And HMRC is spending a lot of time looking at this, and it is a very easy win for them. What they will often do before they come out on a visit, as well as asking for copies of your VAT returns or your VAT workings, they will ask you to run a report of your aged creditors. They come out on the visit, they draw a line at those invoices more than 6 months and say, show us where you have made the adjustment. If you haven't made the adjustment, there is an automatic assessment for HMRC. So any invoices which are unpaid after 6 months must be adjusted for. As I said, it is a major area. HMRC checks on it on every single visit that they come out on. It is part of their standard policy. The important point is that HMRC, you may think it's not too bad because you can claim the VAT when you actually pay the invoice. The issue is HMRC is issuing penalties if businesses have not made this adjustment. HMRC will say that you have been careless and therefore will impose a penalty. They may try and argue something worse, but they could argue at least that a business has been careless, it has not taken reasonable care if it has not made this adjustment. So just be aware, it is one of HMRC's standard checks. They do it every single time. We're seeing more and more assessments being raised and penalties are being charged. We have actually seen clients who have ended up in a situation of having a penalty but having no tax to pay because they were entitled to recover it and correctly in a later period, and the two amounts balance each other out. And because they didn't make the adjustment in one period, HMRC imposed a careless penalty of 30%. So it is the case of be aware of it. It is one of the things that HMRC always look at. The next big issue is HMRC has a big, I think I will say, fair to say, a big obsession about the treatment of VAT and entertainment. The issue is that the business entertainment of UK clients is non-recoverable. And if they can find that you have recovered the VAT, again, it's quite an easy area for them to raise an assessment. It's a long-standing provision which has been in UK law that client entertainment is non-recoverable, and the position at the moment is that entertainment of UK clients is non-recoverable. Entertainment of non-UK clients so has a slightly different treatment, and HMRC now has had to accept that this is recoverable. That used to be the situation prior to 1988, and HMRC tried to change, or did change the law in 1988 to try and block recovery of all client entertainment. Fortunately, they didn't quite do it in the correct way, and there have been a number of legal challenges, and HMRC has now had to admit that if you entertain non-UK clients, the VAT on that is recoverable as long as the costs are reasonable. And we are talking here about HMRC's definition of what would be reasonable. There is no particular definition in the legislation as what is reasonable or not. But obviously, if you are trying to recover VAT on these entertainment costs, as you are fully entitled to do, expect HMRC to make lots of questions, ask about it, and if they think the costs are not reasonable, I think they give an example that if you take people out to sort of football matches in the evening with major lavish entertainment, they would say that that is not reasonable, and they would look for an onward VAT charge to be made. Turning now to the situation on staff entertainment is recoverable in full. HMRC used to challenge this, but the courts have ruled that the purpose of it is to improve staff morale and welfare, and therefore, for VAT purposes, it is fully recoverable. Although there might be restrictions on direct tax reasons, for VAT purposes, you can recover that on staff entertainment however much you spend and however frequently you take your staff out. I know one firm which takes its staff out every Friday, and they say that is to improve morale, and they are therefore fully entitled to recover the VAT on that. So that is what the situation is on staff entertainment. The trouble is, though, there is a slightly different rule which applies to partner entertainment. Partner entertainment is non-recoverable. Again, that is based upon case law, and the courts have said that if partners, equity partners, go out for just themselves, that is not for the purpose of improving any sort of staff morale or welfare. They are the owners of the business, therefore that is not sort of recoverable. It is just a personal cost of the partners. So partner entertainment is non-recoverable. And one thing that HMRC will often do on their visits is they will often pick in advance a number of members of staff, and they will say, can we see their expense claims? And they would like to go through those expense claims in detail. Reason, because it gives them a number of issues. It raises the issues around entertainment, but it also allows them to get an indication of what the business is doing as a whole. So quite often they will ask for expense claims and will then go through them as part of their visits. Just be aware that entertainment, we can have recovery if it's for non-UK clients or if it is for staff, but UK clients and partners, it would be non-recoverable. We've talked about place of supply and when we do not charge VAT. And one of the other things HMRC will often do before they come on a visit is they will ask you to run a report of all invoices where VAT has not been charged, and they might then refine it a little to invoices where UK VAT has not been charged, but they have been billed to a UK recipient. If they do that, they are looking to check, has VAT been correctly charged? Have you been billing UK clients without VAT when VAT should be charged? So what we need to do then is to provide evidence to support the rationale for why VAT has not been charged. We will be looking for evidence to support our place of supply decisions, so we will be looking for copies of letters of engagement showing that the client is based outside the UK. But then we would be looking at evidence to support that, as well as the letter of engagement. HMRC might ask some other evidence to support the fact that the client is based overseas and that it is the overseas office that you have been dealing with. So possibly we may need to provide some evidence to support why we have not been charging VAT. Similarly, on UK clients, there may be good reasons why we have not charged VAT on the supply. It might be that we're doing work involving land overseas, or we might be doing something which is exempt from VAT. But it's again a case of being prepared for these situations. HMRC will ask to see this as part of their routine visits, and we would need to have evidence to back up why we have not been charging VAT. The last bit that I just want to mention about is HMRC and penalties. We know that obviously HMRC is a revenue-raising department, and it is therefore obviously looking to increase its revenue and its take from taxpayers. There is very much an increased use of penalties and a greater issue of penalties by HMRC. HMRC tends to start from the presumption that a penalty is due unless you can prove to them that it is not. And in VAT, we have the same penalty regime which exists across the other taxes. We have the 30% penalty for careless errors, the 70% penalty for deliberate errors which are not concealed, and then the 100% penalty for those deliberate errors where they are concealed. And as I said, HMRC is always looking to raise penalties. Their general starting point is if there is an error, there will be at least a 30% careless penalty imposed, unless you can explain to them why it is not due. And we've heard anecdotal stories that HMRC staff actually have targets for the raising of penalties for deliberate errors at the 70% error. And a deliberate error may not be something which you think is wrong, but a deliberate error could be something where you have adopted a different treatment to what HMRC thinks that the VAT treatment is. Your treatment may be correct, and you may have a really good rationale and real opinion as to why it is that way. But if it is different to HMRC's published treatment, there is a risk that you may end up with a 70% penalty on that. And in those cases, if you do have a different treatment to what HMRC sets out in its guidance, our policy is that you must always disclose that to HMRC, tell them about it, your treatment, say why you have done it, and explain your rationale, and hopefully you will not then have a deliberate penalty. Coming back to the penalties, we mentioned 30, 70, 100% penalties. Obviously, it is possible for those penalties to be mitigated. For example, the careless penalty of up to 30%, it is possible for that one to be mitigated by 50% down to 15% if you make an unprompted disclosure. So if you find an error and you disclose it yourself to HMRC, when HMRC is not already looking into your affairs, that penalty will be mitigated down to 50% of the penalty. So the maximum penalty, if you disclose it, is 15%. Whereas if HMRC come out and discover it, you get a 30% penalty as a minimum. And this is only possible if it is an unprompted disclosure. So you have to disclose it when you think or not aware that HMRC is looking into your VAT affairs. So if HMRC phones up and say they want to come and do a routine VAT inspection, and then all of a sudden you start looking and you then find errors, that is not unprompted in HMRC's view, because you've only done that because HMRC has approached you about a potential visit. The other way in which it is possible for the penalties not to be imposed is if you can satisfy HMRC that you have taken reasonable care in your VAT affairs. So what you would need to do to demonstrate that is that you should to show that this error has arisen in spite of all the procedures and all the policies that you have in place. To be able to demonstrate that you have taken care, you would need to have sort of procedures documented. So, for example, in the completion of the VAT return, you would need to have a checklist to show what checks are undertaken on the VAT return before it is submitted. And importantly, you need to show that those checks have actually been carried out and you sort of evidence the fact that they have been completed. Similarly, if you provide training for your staff, so if you have a VAT training course for your staff, it's possible to then help show that you are taking reasonable care over the dealings in VAT. As long as you can satisfy HMRC that you have taken reasonable care, there should not be a careless penalty imposed. The final point to make on penalties, which unfortunately is not on the slide, that for a careless penalty, it is also possible for HMRC to suspend that penalty. What that is they agree that you have made an error, you are liable to the penalty, but they agree with you not to impose it for a set period, normally a period of 18 months to 2 years, and there are a number of conditions which they will impose. You don't have to accept it, you may decide you wish to pay the penalty. If you do accept the VAT penalty suspension conditions, beware, you need to check that you can keep to them, because if you cannot keep to them, the penalty automatically becomes payable. And the one thing to make particular care about is that there is usually a condition which says that all tax payments and returns must be made on time. It might be a VAT error that is made, but they will want to ensure the conditions will say that all tax payments are made on time, or all returns are made on time. And that will be PAYE as well as direct tax and VAT returns. So as I said, be aware that HMRC is using much greater use of penalties. If we have procedures in place and we can evidence that they have been undertaken, hopefully we could show that care has been taken, and that should reduce our risk of penalties.
Thank you, Michael. Now, we've had a number of detailed questions, some of which we're not going to get to, but we'll respond to after the webinar. So just a general question about the budget that's coming up on the 8th of March. Has there been any indication that there's going to be any big changes in the budget, or are we uncertain?
Quite interesting to think, what is your question about what will happen in the budget? We know the Chancellor has rebranded it as, I think, his spring statement. We're not expecting any big VAT announcement, but who knows, there might be some. We're not expecting anything, but once before when we weren't expecting anything, there was all the issue about Pastygate and all the pasty. So I think the answer is no, nothing expected, but who knows?
And watch this space.
Watch this space.
Okay. And further question just on Brexit. Once we have a bit more freedom in terms of what we do with our own VAT rate and what we charge it on, has there been any indication that the rates might actually be reduced after Brexit?
I think there's not necessarily been an indication that the rates might be reduced, but I think we may have sort of different items might be put into the zero rate. Maybe some of the items might be currently the reduced rate, because that was the lowest rate we were able to have, such as domestic fuel and power. There is a wish maybe for those to be put back to the zero rate where they originally were, but we wait and see, because it's just a greater flexibility. Maybe we might have something around e-books. We might have greater flexibility to treat them in the same way as hard copy books. Wait and see.
Again,
fortunately.
Watch this space. Okay, so I mean we're hearing all over the place that compliance from HMRC is top of the list, making sure that clients are complying with the regulation requirements, recording and paying the right level of taxation, no matter what tax it is. What is your final recommendations to our audience about what they should really be focusing on in order to minimise the risk of penalties and falling foul of HMRC's view that they're not complying?
I think if we're talking about trying to ensure that we have compliance, it is ensuring that we have sort of procedures sort of in place, that we document those procedures, which is obviously going to be very helpful when you have, when you have a staff turnaround. Someone might leave who's always done the VAT return. How does the new person know? How does this firm deal with it? So it's useful to have these definite procedures in place to show that they are undertaken, that you document that the necessary checks have been taking place. And I think one of the issues is possibly that you have suitable training for your staff. One of the questions I often get asked is, can you help us with doing some training for our staff? And we are very willing to help do sort of bespoke training sessions for professional firms, assisting their staff on VAT, giving training them on specific issues that they will face.
Sure. So it's about creating some space and time in order to not firefight and really focus on the right plan.
That is correct.
Get procedures in place and really think through what our risks might be.
Correct. Yes, I would agree.
Okay, wonderful. As I say, there's been a number of questions that we'll respond to in person, but thank you very much to the audience for listening. It will come to the end of our webinar, just under the hour. Thank you very much to our speaker, Micheal Ashdown, very enlightening, very scary, but very enlightening. And thank you very much to our audience